Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, and it is September 21st, day after the FOMC meeting here. We've got a few economic news releases to go over today. We'll stop by and we'll take a look at that. Sorry about that noise there. Start off with the weekly jobless claims that we have every Thursday. So last week we had 282,000 people apply for unemployment. Forecast for this week was 302,000 people, and it came in at 259,000. So this is kind of a surprise because after two major hurricanes, we figured it would be much greater than this. That's why they're projecting 302. And that one week, about 2 weeks ago, it was like around 295. But yet, that's the highest we've seen. So jobs haven't been as bad as we thought they were, at least not initially. So unless we get a big, huge amount of people applying for unemployment in the next couple of weeks, it's been holding up pretty well here, which is obviously a good sign for economy-wise. Philly Fed, this is the manufacturing numbers out of the Philadelphia region. We had an 18.9 in the month of August, and in September it increased to 23.8, so good numbers over there. Last but not least, we got the leading economic indicators for the month of August. So July, it went up 0.3%, and then August, it went up 0.4%. So again, leading to positive news right there. Let's go ahead and take a look here at the headline news. The stock market is down. It's kind of taken in. It's really more or less the after effects of the FOMC announcement yesterday. So if you hadn't heard the FOMC announcement, they left rates unchanged, as we mentioned. But the Fed funds future rate for December went from for a rate hike, went from about approximately 25% of a possibility of a rate hike all the way up to 75, because the Fed kind of indicated they would have another one this year and probably three for 2018, three rate hikes. So with that in mind, the real big news is what they're dubbing the Great Unwind. So what is that? It is basically the $4.5 trillion that they've accumulated during the QE of between mortgage-backed securities and treasuries and such, when they kept purchasing all these to try create more liquidity and get more growth and jumpstart the economy. They've accumulated $4.5 trillion. They stopped doing that in 2014. And now they're sitting on this, and now they're talking about unwinding that. So how are they going to go about doing this? Here's the plan, what they're planning on doing. They're going to start doing this in October. Basically, what they're doing is they're going to basically, as you may know, mortgage-backed securities and treasury, all of them, they have maturity dates. So when they mature, or when they get, like when somebody has a house and they sell and now that mortgage is done, or when they refinance again when that mortgage is finished, they're going to basically withhold $4 billion each quarter of reinvestment, because what they've been doing is they've been taking that and then reinvesting that money back into new ones. So instead of reinvesting it, they're just going to cut back $4 billion each quarter up until they reach $20 billion each month. So this is each month. So $4 billion for next 3 months, then $8 billion the second quarter, all the way up to about next year will be they should retain that. Now, in a perfect world, if they maintain this, they should be complete with this by 2025. They should have it all undone. Now, that's what we see in a perfect world, is that's assuming that we don't have any recessions in that process or anything else that might need a jump start, primarily because right now we're about year 9 of not having any recession, and this country's never gone 10 years without a recession. So for that to happen, that means we would basically have 17 years of no recession in that period, and that's a pretty long time to guarantee that there's no recession. So again, they're kind of throwing this out there, trying to be transparent. Obviously, we'll have to see how much they can unwind before they have to kind of fix and move things. But this is unprecedented. We don't know exactly how this is going to shape up, because again, we haven't been in this situation before. We haven't encountered this, and this is how new territory that we're exploring here for this. So out of that $4.5 trillion of the balance sheet, only 1.8 trillion of that is actually mortgage-backed securities. So again, that takes. So when we talk about that $4 billion, all that, that's going to be of the mortgage-backed securities, not of the 10-year, mortgage-backed securities. So they're going to do something similar with the treasuries, but because we're talking more primarily mortgage-backed securities here on this, and interest rates, that's what drives the interest rates, mortgage-backed securities. It's going to take approximately 7 years in a perfect world to attain what they want to do when they become fully unwound, so to speak. So let's go ahead and take a look, see what the bond market is reacting today. After that news, as you can see, we dropped quite a bit. We dropped below the 50-day moving average, and now our floor of support is this 100-day moving average, kind of like the 10-year Treasury, which you'll see in a bit. If you recall, the 10-year Treasury has been kind of going this last few days, been hovering between the 50-day and 100-day moving average in this tight range there. So as you can see, we did try to test it, and we pulled back. And right now we're up about 3 basis points. So we did test the 50-day moving average already today and got pulled back on the bond market. So rates are about the same as where we left off yesterday. We did have a price change for the worse, which means they had intraday pricing and interest rates worsened yesterday. So we're pretty much about the same level where we worsened yesterday. Here's a 10-year Treasury. Oops, sorry about that. Here's, as we mentioned, here was the 50-day moving average, and here's the 100-day. We broke above that yesterday, and now we're hovering between the 100-day moving average and the 200-day moving average. But if we can keep maintaining this here, we could potentially have another roll reversal here. Especially, we're down about 2 basis points, so now about 2.25, 2.25 basically on yields right now. So, but if we can keep this going, keep going lower, we could have a nice roll reversal and see an improvement in our interest rates going forward here. Again, this is all unprecedented. It's hard to kind of project as to if we're going to have better or worse rates due to the great unwind here, but should be interesting to see. All right, so that pretty much concludes it today, but if you guys want to get more updates throughout the day, just come over to Twitter, and I do post on Twitter under the handle Mike Bjork. Feel free to come over there and check it out. You guys have a great day. Thanks so much for watching. We'll see you guys tomorrow.